the current issues with U.S. trade specifically are heavily tied to the global monetary system as it's structured. So going back to my point that every several decades, these things tend to change pretty substantially. This is potentially more than just a trade cycle. Part of why so many entities even talking about a monetary change or a change in structure is because it's so tied to trade. And a point that I've made is that basically the other side of being the global reserve currency is something in your economy is generally getting hollowed out. We are gradually hollowing out our industrial base to maintain our kind of global dollar empire.
Throughout history, the global monetary system has only undergone a few major transformations. The 1940s saw World War II, sovereign defaults, and the birth of the Bretton Woods system. In the 1970s, the U.S. decoupled the dollar from gold, triggering energy shocks and ushering in floating exchange rate. The 1980s brought a final attempt at coordination through the Plaza Accord. Today, according to macro analyst Lyn Alden, we're entering a fourth major transition, one that isn't negotiated in a single moment but is unfolding gradually through inflation, liquidity shocks, supply chain disruptions, and a more multipolar world. Lyn sees more than just short-term noise. She identifies deep structural cracks in the foundation of the dollar system. A long-term debt cycle is nearing its peak, and the strong dollar era is losing steam. Meanwhile, U.S. policymakers are trying to fix trade imbalances and revive domestic industry, all while holding on to the extraordinary privilege of issuing the world's reserve currency. The system is under pressure, and the consequences could be far-reaching. In this video, we break down Lyn Alden's macro thesis: how debt, trade, and currency cycles are converging, what a meaningful dollar devaluation could set in motion, and why the cost of maintaining global financial dominance may soon outweigh the benefit. Whether you're investing in emerging markets, watching the bond market, or allocating to Bitcoin, understanding what comes next for the dollar is not just important, it's foundational.
Tired of hype and zero value on YouTube? Meet Fefe, a full-time trader, educator, and a thought leader in crypto. He bought his first Bitcoin at 700 USD in 2016, and since then he's built a loyal community by doing most can't. Calls the market direction with unbelievable accuracy, hosts daily live shows filled with the latest alpha on YouTube, drops daily alpha and market updates on Twitter, interviews top minds in the industry, hosts weekly cash giveaway for his community of over 70,000 people. He's also a top presenter at Crypto Banter, one of the largest crypto YouTube channels out there with over 1.2 million subscribers. Click the link below and start following Fefe.
Historically, we go through certain monetary changes. There are a couple different cycles that kind of overlap. One of them could be considered the long-term debt cycle. So debt builds up in the private sector, then generally gets transferred more toward the sovereign level, and then gets basically debased or inflated away. That's kind of one big cycle that developed economies go through in modern history on something like an 80-year cadence, but it can vary. And then just more broadly, there's this kind of imbalances that build up in any sort of complex system, the way that these are currently constructed. And so even between those, say, 80-year periods, there's usually like a midpoint where things change. So for example, the midpoint between the past kind of long-term debt cycle, which was the 30s and 40s, and the current one was the early 1970s. That was a different type of default, a different type of monetary change. And so I agree with you that this is kind of a historic moment. I don't know if there's a specific date that's going to stand out to quite the same way. Maybe Liberation Day, maybe another time what we pick, maybe the moment that Russia invaded Ukraine, and then there are all these sanctions triggered. That maybe it's just the pandemic itself that was kind of a catalyst for a lot of things as well, fiscally speaking. So I don't know exactly what date or period will be highlighted as like the points, but I do think that this era will be looked back upon, much like the 70s, much like the 30s and 40s, as a time of change in the way that the global monetary system is constructed, and the way that a lot of domestic finances work. I generally put something like the Plaza Accord on a smaller level than the bigger things I mentioned, because that was more of like a pivot point within a current structure. So that wasn't really like the foundation shifting. That was more like a bunch of entities agreeing to kind of keep that system going. Because otherwise, that's the system that we've been in since the 70s could have broken earlier had certain things become totally unbounded. And that was one of the kind of events that kind of kept it going, kept it kind of sustainable, for lack of a better word, or at least longer sustained. And I do think that the something like a Mar-a-Lago Accord could absolutely occur here. If you look back to the early 1970s, when this current kind of floating exchange rate system really began, there's really only been $3 cycles. So major periods of dollar strengthening compared to other currencies and then weakening compared to other currencies. These have had very big investing implications each time. Generally speaking, when you have this kind of weaker dollar periods, you're looking at more inflationary periods, you're looking at more value stock outperformance periods, you're looking at more international stock outperformance periods. Whereas when you're looking at the stronger dollar periods, you're generally looking at more disinflation, you're looking at more growth stock outperformance, you're looking at more US stock outperformance. And so, we have been in a strong dollar environment for quite a while now, since about 2014. So we're something like 11 years in what is a fairly strong dollar environment. And should we get another leg lower in the dollar, either just due to policy flow shifts, kind of like, say, the early 2000s dollar bear cycle, or a more intentional dollar bear cycle like 1985, the Plaza Accord, we could have a Mar-a-Lago Accord. That has a variety of major investing implications, but it's not necessarily a structural change in how the system works. So I do think that we could certainly be geared toward something more than just that, because some of the things have been building up for a lot longer than just, say, a dollar cycle. But that is kind of a one key thing to watch for any of us that are involved in markets or follow the prices of assets we own. So that is a key thing to watch. I mean, if you look at the $3 cycles of modern history, each one is kind of a lower high than the prior one thus far. So even though, like you said, it's not as high as 1985, it's a different world than it was back then. And so the system starts to kind of break at a lower high than it used to. Back in the 1980s, there's both in the US and elsewhere, there's a lot less debt in the system. And so it could go a lot further before it would run into problems. Whereas now the feedback loop is a lot tighter. And so it runs into issues sooner. So yeah, ever since 2014, roughly coincided with the end of QE3, quantitative easing 3, the third round after the global financial crisis. When that ended, we had a pretty strong dollar surge. And although it's fluctuated, it goes up to, say, at 100 on the dollar index. It's gotten as high as like 114. It's gotten down. So it goes through these kind of waves in this period. But during that 11-year stretch, it's all been pretty elevated. And we look at it on a trade balance basis, it's very strong. When you look at its effects on, what type of assets are doing well, what types of economies are booming or not booming, it's all characteristic of a stronger dollar environment. Generally, when you get a truly weaker dollar move, you'll get something like an emerging markets boom for maybe 3 to 5 years. You'll get probably a round of inflation. You'll probably get a round of kind of value stock outperformance. We've not really seen any of that at scale. Sometimes you have individual years of that happening. For example, 2017 was a good kind of rotation year for those types of assets. This year so far has been somewhat of a rotation year, but these are kind of smaller moves compared to what you can get when you have a true, say, 20-30% currency shift involving the dollar.
And then when you see these big shifts happen in the dollar, going back into a weaker dollar, then that tends to correlate with like global M2 increasing. So the money supply starts increasing when that goes down, and that's also part of what pushes these other markets back up?
Yes, indirectly, because many cases, global M2 will be measured in dollars, because global M2 has a bunch of different units, all the different units of the major currencies. And so when you're kind of reporting what is the value of this figure, it's normally reported in dollar equivalents, because that's the global reserve currency. And the reason it's really relevant is because out of all the major currencies, the dollar is by far the most important cross-border funding currency. So there's something like $18 trillion worth of dollar-denominated loans and bonds that are cross-border in the world. And so it's the unit of account for liabilities, which is really important. So when the dollar is weakening, it means various entities around the world, their liabilities are weakening, which is good for them. Whereas when the dollar is strengthening, their liabilities are hardening. It's like if you took out a mortgage in Swiss francs, but say you're renting it out and all the cash flows are in dollars, you're in a world of pain if the Swiss franc doubles compared to the dollar, whereas you're doing great if the Swiss franc gets cut in half relative to the dollar. And so that's what happens kind of the whole world. And so whenever you do get that weaker dollar environment, yeah, you get a surge in global M2, but it's mainly because the denominator is going down. But then also what that does is that allows emerging market central banks around the world to kind of loosen a little bit. Because during strong dollar environments, even if they encounter a recession, they often have to be pretty tight with their monetary policy to avoid currency crises. And so when they do get that weaker dollar period, they're able to kind of actually stimulate for a change. And that's when we tend to get that little bit of a rotation.
Yeah.
Lyn Alden argues that every few decades, the global financial system reaches what she calls a structural midpoint, a moment that goes beyond typical recessions or debt cycles and marks a fundamental shift in the rules of monetary engagement. The last such midpoint occurred in the early 1970s, when the Bretton Woods system collapsed, gold was removed from the monetary equation, and the US dollar became a free-floating, sovereign-backed fiat currency. Today, Alden suggests we may be approaching another major inflection point. But unlike in 1971, when President Nixon's actions marked a clear break, the current transition is far less defined. Instead of a single event, we're seeing a slow convergence of systemic pressures that together signal deep structural change. This shift is being driven by a combination of forces: the economic aftershocks of the pandemic, intensifying sanctions and tariffs, rising geopolitical tensions, and a global debt burden so massive that currency debasement may now be the only politically viable option left on the table.
People usually don't lose sleep over where shirts are made, but they do lose sleep over where complex machinery is made, especially if it's a handful of kind of places in the world.
Yeah.
So, and there's a weird things you don't think about, like pharmaceutical components, medical dyes that are needed in like imaging, just little widgets here and there that our industry is just heavily reliant on. And if you do have some sort of trade embargo, you can have a national security issue and kind of shortages and things like that. So if you look at, for example, that Stephen Myron paper, so Stephen Myron is Trump's chair of the Council of Economic Advisors to the president, and he kind of outlined that the trade imbalance is directly tied to the currency issue, and that there is somewhat of a trade-off there. One of the challenges that I think the administration, as they're approaching it, is not really talking about that other side of it. They want to retain every single benefit of the dollar as the global reserve currency, but then they also want to fix the trade element, even though they're kind of tied at the hip.
Right.
And I think that's where they potentially run into frictions, because it's more like you're treating a series of symptoms rather than talking about the elephant in the room, which is kind of the root cause, because it's very wonky to talk about. You know, it's not something like all the stuff I just said is terrible at a political rally. It's not, no one's going to clap. It's not fun. It's not energizing. There's no enemy. It's like, it's cumulative decisions that us and others have made collaboratively for decades.
Right.
And so that's the challenge. And there's no kind of narrative political gain from saying we're actually being harmed by being the sole reserve currency now, that the downsides of it are kind of equal or exceeding the benefits of being it. And it's a whole wonky subject to talk about. It's more about kind of we're in a more multipolar world now, and there are realities associated with that. But yeah, none of that carries political capital to bring up. And so it's a lot of the focus is on the tariff side, the trade side, but the challenge being that's only one side of the coin.
Yeah.
To grasp the full stakes of today's monetary shifts, we need to zoom out. Lyn Alden identifies the end of quantitative easing in late 2014 as the beginning of the current strong dollar cycle. Since then, we've seen U.S. asset dominance, subdued inflation, and increasing strain on emerging market. But if history is a guide, a weaker dollar phase may be next, and the consequences could be significant. Past cycles show that every dollar peak since the 1970s has been lower than the last, reflecting declining global tolerance for a weaponized currency. During previous weak dollar regimes, value stocks outperformed growth, emerging markets surged, commodities rallied, and capital rotated away from the U.S. and into international asset. These patterns aren't just coincidence, they're rooted in financial mechanics. With over $18 trillion in cross-border debt denominated in dollars, a weaker dollar shrinks those liabilities in real terms, giving foreign economies more room to stimulate and grow. But this dynamic is part of a much bigger structural issue. Alden describes the architecture of dollar demand, trade deficits, and capital flows as the cost of reserve currency privilege. In the Bretton Woods era, the U.S. paid that cost by bleeding gold. After 1971, it paid by hollowing out its industrial base. States like Michigan and Ohio bear the brunt of this system, while capital concentrates in places like New York and Silicon Valley. This imbalance isn't a policy error, it's a feature of Triffin's dilemma. To supply the world with dollars, the U.S. must run deficits, which means importing more than it exports and sacrificing manufacturing in the process. So when the US tries to revive domestic industry with tariffs and subsidies, it's fighting against the gravitational pull of the dollar system itself. According to Alden, this is the core contradiction Washington avoids. You can't have both a globally dominant currency and a fully reindustrialized economy. There are signs of potential course correction, including quiet discussions around a possible Mar-a-Lago Accord, an echo of the 1985 Plaza Accord, to engineer a controlled dollar devaluation. But even that, Alden warns, would be a short-term patch, not a long-term solution. The real risk lies in an unmanaged decline of dollar dominance, which could trigger fragmentation of the global monetary system, capital flight from U.S. treasuries, and chaos in commodities, trade, and geopolitics. For investors, this isn't just macro theory, it's a real-time risk map. Bitcoin and gold gain traction as trust in fiat erodes, emerging markets become attractive again, and commodity rallies are driven not just by demand but by currency realignment. U.S. equities could face relative underperformance unless the dollar adjusts. This is the macro backdrop that may define the next 5 to 10 years.
For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.